Boom! What's going on, Investomaniacs? Your boy, a Knight Rider here. Today, we're going to be talking about Snap Inc. and ServiceNow. Up first, we've got Snap Inc., probably better known as Snapchat, the image messaging app. Now, Snap Inc. was originally Snapchat Inc. when it was founded in 2011, but the name was changed to reflect its expanded range of apps and products, which now include Bitmoji, Spectacles, those little sunglasses that take pictures, and Zenly. I like Bitmoji. That's pretty popular. Snap Inc. is a divisive company. Some people believe it's the next Facebook. Others believe it's the next Vine. And maybe it'll just be somewhere in the between, right? It'll be the next Twitter, just its own thing that will exist in the ether independent of Facebook. The problem is it's a little bit too close to Instagram, and so those two companies really are going head to head. And for the time being, Instagram is absolutely smashing Snapchat. A couple years back, I did think Snapchat was going to be like a real huge thing, and it was growing super fast, and it was super popular. And it just seems like once Instagram started copying Snapchat, things really kind of slowed down for Snapchat. But nonetheless, on one hand, Snapchat is exciting, it feels modern, and it's relevant with millennials and Gen Z. A lot of younger people still are using this. According to NASDAQ, Snapchat has reached a staggering 90% of all 13 to 24-year-olds in the United States. That is a much sought after demographic. Its product line has expanded a fair amount over the past few years, demonstrating a tendency and ability to grow and adapt. And there are a few favorable numbers, particularly its top line growth. Snapchat is up 39% year over year, and user engagement has remained steady. One argument for Snapchat is it still has a significant amount of ad revenue growth ahead of itself if it can figure out a better way to monetize the platform. The Snapchat platform, the way you use it, just doesn't really lend itself well to a whole bunch of ads, unlike the scrolling nature of Facebook and Instagram and even Twitter, where you're just constantly scrolling through it. It's a lot easier to just pop ads in there. However, when we look a little bit deeper, we see a less than stellar reality, right? 39% top line growth sure sounds great until we consider that top line growth was at 104% just a little over a year ago in 2017, and has been decreasing practically every successive quarter rapidly. Now, if Snapchat were profitable or close to it, I'd be perfectly fine with this rate of deceleration, but Snapchat isn't profitable. In fact, for every dollar of revenue it brings in, it loses 94 cents. When you are that far away from profitability, you need more revenue growth with less deceleration. And while Snapchat's vast user base and exciting contemporary model might appear to indicate a thriving business, the reality is far from it. Since Snapchat's inception, net losses for the company have exceeded $6 billion and is bleeding every year from stock-based compensation, which has taken up half of the revenue from Q1 this year. I want to say that again, half of the revenue was spent in stock-based compensation alone. I've said it before, I will say it again. Just because you like a company doesn't make it a good investment. Snapchat offers a wonderful product for free, but the business model does not currently work. If you want to invest in Snapchat, I would recommend parking your money in something like a Facebook and keeping a close eye on Snapchat. If or when things start to look a little bit more promising, then you can pounce. Trust me, you'll still be in early. Now let's move on to more promising pastures with ServiceNow, an American cloud computing company. ServiceNow specializes in a variety of online services, ranging from software management services to corporate IT services. The company is currently led by CEO John Donahoe, the former president of eBay Marketplaces and current chairman of PayPal. Let's get right down to it. I like ServiceNow. ServiceNow is a highly attractive stock this year and as well as last year. Revenue growth was up 35% in 2018, and unlike Snapchat's dreadful negative 94% operating margin, ServiceNow's operating margin is at a much more reasonable negative 1.3 operating margin. Plus, ServiceNow is free cash flow positive. That is important. It's okay if you're negative on the bottom line as long as you're free cash flow positive. In a down economy, if you can't raise new money, you'll still be okay. In 2019, we've seen the company strike up several exciting partnerships which promise future growth. In May, ServiceNow announced a partnership with Google, which will be integrating ServiceNow's IT management systems into Google's cloud services to streamline its IT work. ServiceNow also announced collaborations with the British professional services network Deloitte, which currently provides tax advisory services to 90% of the Fortune 500 companies. As a reflection of its business growth, ServiceNow also recently purchased a new headquarters in Santa Clara to provide a space for upwards of 5,000 new employees. As an investor, I like seeing large commitments like that. It demonstrates to me the confidence management has in the business. ServiceNow is a hot company in a hot market. Cloud companies are highly promising at the moment, and you got to pay for that. With revenue estimates for the industry currently at over $330 billion by 2022. And even with that booming market, ServiceNow stands out as a winner. I like ServiceNow and I say it's a buy, but high growth software as a service companies that are on fire are not for the faint of heart. They trade at a steep valuation, and there's no earnings or dividend to keep it from falling in a down market. You must be willing to accept a 70% down draw to be in these types of stocks. If you can't take the heat, stay out of the kitchen. But I like it. Until next time, Investomaniacs, may the market be ever in your favor.